All right, so good morning to you all, crypto ambassadors. It's another wonderful morning, and as we used to do, we are about to start our lesson. So please, I urge we all share the link so that our team members be able to join us for us to start. Right? So, those in the chat box, yes, we've not started, but we are going to start soon. We're going to start soon. So please share the link and let them join us so that we can start as soon as possible. Yeah. So we are here. We're going to start right away, okay? So let's share the link. All right. So whilst we are about to start, let us do this little introduction. Let us do this little introduction before we start. So, as we used to do, let me know your name and where you are joining from in the chat box. Let me know your name and where you are joining from. And mind you, we are supposed to be more than this. So um we are supposed to be more than this, okay? So I expect you to continue sharing the link so that at least we hit more than 150, because we are supposed to be more than this. So Byron from Kenya, you are here, you are welcome. Nana from Tanzania, Richard from Ghana, okay, you are welcome. Damili Masaka from Uganda, Jacqueline from Canada, Nancy from Kenya, and then also Paul Orr from Kampala, Uganda. You are welcome. Okay, so we also have David from Uganda, and then also Crypto Explorer from Burundi. We have Christian from Uganda, Ronaldo from Calta, Tafi from Uganda, and then also Masaba Isaac from Uganda, eastern part of Uganda. So you are welcome, Masaba. We also have Wise from Kasubu. From where? Kasubu is from where? It's located in which part of the country? We have Desmond in Cameroon, then also ZP from Kenya, Amos from Uganda, Godwin from Ghana, that's Volta region to be precise. We also have Florence from Nigeria. So Trader from Kenya. Okay. All right. Then Makalik from Uganda, Bangwa Bangwa Estate. Bangwa Bangwa Estate. So we also have Tiga from where Tanzania, Friday from Kenya, Nairobi, Engineer Nate inside Ghana. Which part of Ghana? Ernest from Ghana, and then also Kasupi from Kampala. Then we have Joy from Kenya, and then also Margaret from South Sudan. South Sudan. You're welcome, Margaret. We also have Boniface. Boniface from Nairobi, Kenya. Then also Pascal from Kenya. Pascal from Kenya. All right, so Pascal, you are welcome. We also have Kalama from Kenya. Kalama from Kenya. Okay, so guys, let's continue to share the link. And whilst you join, mention your name and then also where you are also joining from. So we have Nasiruddin from Ghana. Nasiruddin from Ghana. Okay, Nasiruddin, you're welcome. So we also have Juma from Qatar, Doha. Qatar, Doha. Okay. So we also have Nikas from Tanzania. From Tanzania, Christine from Mukono. Which country is that? Is it Uganda? We also have Eunice from Nigeria. Then Shem from Kenya, Uganda, and then um okay, that is Uganda, right? Okay, that is fine. So David, you are welcome. David from Nigeria, you're welcome. Then Mami Fosua Asante to from where? Germany. I mean, Fosua Sante from Germany, and I seems this to be a Ghanaian. Okay, so Tahid from Nigeria, and then also Promiga from Nigeria, Cozy from Tanzania, Edwin from Ghana, Sylvia from Uganda, and then also Whisper from Kenya. Whisper from Kenya. So, guys, we are we are surrounded around the globe, and we are all getting back here this morning to learn and understand the concepts of trading. And this is so amazing for you to be here this morning. So, Winnie from Kenya, and then also Alexander from Tanzania. Alexander, you are welcome. Robert from Abu Dhabi. Robert from Abu Dhabi. So, guys, you are all welcome to this morning session where knowledge is impacted and shared among ourselves. So, David from Ghana. David, you are welcome. All right, so guys, we are 122 now, and I guess we are good to go. So, this morning, it's basically about introduction to futures trading as we used to do every Wednesday. In Crypto Ambassadors, we believe in consistency. We believe in consistency. And for you to succeed in life, it's not about doing different things. It's not about doing different things, but it's about consisting on the same thing over and over. That is the reason why if you are the type that you find boredom in everything, you cannot succeed. So we are going to consist in knowledge by continuing and consisting on whatever we do learn every day, so that all the messages will be at your fingertips, right? Okay, so Nicholas from Uganda, you are also welcome. Let me see. Please, those who join without muting your call, mute your call. Mute your call. Once you join, mute your call. Okay? Once you join, mute your call. Yes. We don't need your background noise. Neither do we need any noise from you. So when you join, just mute your call so that we can. Very good. Okay, so we have Alpha from Kenya and then also Bright from Ghana. Bright from Ghana. Okay, so guys, you are all welcome. You are all welcome, and another wonderful day. So far, so good. Trading on the futures market has been so amazing. Whilst bangering the market, it's really bring tremendous change and impact in our trading journey. And this shows how leadership gets. This gives us the momentum. We've gotten the understanding that it's always important for you to also be creative, for you to be willing to also move forward, right? And I think bringing and trading on the futures market is really making good moves. It's a good move so far. And I'm happy with that. And I believe you are also happy with that. That is the reason why we need to continue and consistent on in knowledge to ensure whatever we are learning will be at our fingertips. Right? So I welcome you all once again to this morning session, which you are going to do the introduction to futures trading for you to understand the basic concept of trading on the futures market, the terms associated with trading on the futures market, and then also how you can trade on a futures market. So this is an introduction to futures trading where we break down complex ideas into simpler words for you to understand and then also make good use of them. Now, I've always been saying one thing that things become complicated when you don't understand. But once you understand and make good decisions about your journey in trading, you always continue to make money. You always continue to make money. I see people doing, oh, I didn't understand. That's the reason I make this decision. So it's always good for you to understand why you are trading and what every single time mean in your trading journey, especially on the futures market. And once you understand that, whatever goes, whatever comes, you know the reason why things happens. You get it. So as a trader, you are not supposed to be ignorant about your trading. As a trader, you are not supposed to be ignorant about your what? Your trading. And it is your responsibility to ensure you learn to understand every single part of the market, right? It's your responsibility to understand every single part of the market so that it will help you to be able to make an informed decision. Okay, so that it will be able to help you to make an informed decision. All right, so let me share my screen for us to start. But before I share my screen, let me see. Okay, so um, I'll make two people here co-hosts so that in case I'm out, they would help me. In case I'm out, can I do that? Oh no, let me see. So, Ambassador Paul, let me make you a co-host. So when I'm out, you inform me. Okay. So who again? Let me see. Mm, okay, so I think Ambassador so do that for me. So anytime I'm out of the meeting, alert me so that I join. All right, so guys, welcome to the introduction of futures trading. And this is where, like I said, complex ways is breaking down into simpler understanding for you to grab the concept of trading on the futures market, for you to grab the concept of trading on the futures market. And I believe now you can see my screen. My screen is visible, right? Okay, so futures trading. Hmm? Futures trading. All right. Now, futures trading is one of the advanced trading in the financial markets. Futures trading is one of the advanced trading in the financial markets. And fortunate for us in Royal Q, we trade on both the sports markets and then also the futures markets. We trade on both the sports market and the futures market. So this morning, what we are going to do, we are going to learn about the futures market. And you should know that futures trading is an advanced market. Okay? Futures trading is an advanced market. So, which simply means whatever knowledge that you've got on the spot market, if you are joining the futures trading, you should make sure that you've advanced your knowledge. You should advance your knowledge further. Do you get it? Because futures trading is an advanced trading. And when it comes to futures trading, it's not only in crypto that we do trade futures. Okay, like I said, it's an advance. There are people who trade futures on gold. There are people who trade futures on this. But the difference here is that we have got an artificial intelligence that break down things for us, that strategize things for us, that simplifies trading, and then also makes us to gain good profit consistently whilst compounding our money, right? And that is what makes everything to be so unique here. So, trading on the futures market, we may ask what is futures trading and how does it works? So, we have about 9 different exchanges in Royal Hill, and all these exchanges, I think six of them trade on futures. Okay, not all the exchanges that we have trade on futures. I think J.io or one of the exchanges, either one or two of the exchanges that not trade futures. Either Gate.io or one of the exchanges does not trade futures. Take notice of that. So, about out of these 9 different exchanges that we have, about six of them trade futures trade have futures trading that you can be able to set up and then also trade on the futures market, right? Now, the main idea of trading futures is to help traders to simplify trading and then also use little capital to make fast profits, make profits. Hmm? So when it comes to trading on the futures market is easy to trade. Though it's an advanced market, yet it is easy to trade. use your little amount of money or your little capital to trade and make good profit, right? So in other exchanges, the broad market is mostly called derivatives. The broad market is mostly called derivatives. When we talk of derivatives, derivatives is a combination of advanced markets, okay, or advanced tradings like futures trading, futures, perpetual futures. So perpetual futures, perpetual futures, option, and then also all these are mostly termed as what? As derivatives. So those using Bybit, you it will be mostly you wouldn't see futures or perpetual, but you see derivatives. Those using Bybit, mostly you wouldn't see futures or perpetual, but you're going to see derivatives. So derivatives is the general name for all these advanced markets. Derivatives is the general name for all these what? Advanced markets, right? So when you're using Bybit and you see derivatives, it's not something different. We are still talking about this advanced futures market, right? Good. Now, we have two forms of futures. We have the futures based on contracts and then there's perpetual futures. We have futures and then perpetual futures. The difference between the futures and then the perpetual futures is very simple. With the futures, it comes with an expired contract. An expired contract. So the actual futures market is based on expiration, which simply means if someone decides to trade futures on this particular market, the asset is based on expiration, which when you say expiration, it expired. So when you trade, let's say BTC slash USD. Now, this particular contract is having a time limit that it's going to end. So for instance, you have BTC USDT that you are trading, and they said your it will expire around maybe 11 um 2025, which simply means if this trade decide to be in the market till November 2025, automatically this trade will close. So this is called futures. It is not perpetual futures. So over here, we are trading on perpetual futures, and the difference is simple and very clear. The difference between the futures and the perpetual futures is that the perpetual futures is unlimited. The contract is what? Unlimited. We simply, just like the name derives perpetual. When we say something is perpetual, it simply means it is everlasting, it is forever, okay, it's perpetual. That is what it means. There it has no end. So perpetual futures is a futures market based on contracts but does not have expiration, it does not expire. Hmm? So the actual futures have got expiration, and then the perpetual futures does not what expired in trading, right? So when it comes to trading on the perpetual futures market, we said the futures market or the perpetual futures market is a market based on contracts. Hmm? It's a market based on what? Based on contracts. And the reason why traders are able to use less amount of money to make good profits or huge profit is because of the contracts that it's being given, right? Because of the contracts. So whenever you are trading in the futures market, you know you are on a contract. And anything that has to do with a contract, it simply means it based on agreement. Hmm? Any contract is based on what? On what? Agreement. That is what it means. So we said the futures market is a market based on contracts. So every contract is based on what? Agreement. Hmm? Do you get it? Every contract is based on agreement, which simply means when you violate the rule or the agreement, there should be a penalty for that. Hmm? Once the agreement is violated, there should be a penalty for that. So in the futures trading, what makes it an actual contract is that the trader is giving what we call leverage. Leverage. Hmm? The trader is giving what we call leverage. So it is the leverage that makes the futures market an actual contract. It is the leverage that makes the futures trading an actual contract. So if there is no leverage, there is no contract. If there is no leverage, there is no what? There is no contract. So the futures market is made such that the trader will be able to leverage on the exchange to make profit. Leverage on the exchange to make profit. So when we say leverage, that is the ability to take advantage over something. Okay, so they are giving you power. So let's assume when we talk of leverage, your money is $5. They said you are going for a leverage of 10. It simply means though your money is $5, but you want to use 5 times 10 of your money. That is 10 times of your capital to do or to trade. Which simply means 10 times of your capital is going to be 10 times or times 5, which is going to be 50. Which simply means your actual money is $5, but you want to go in the market with $50. Is someone learning here? Or I'm going fast? Is someone learning here? I'm going fast. Are you learning? For learning, give me one in the chat. Is someone learning here? I'm going fast. Very good. All right. All right. Okay, so very good. Let's proceed. So once a trader understands this concept of leverage, you know that you are borrowing something, okay, to trade. So it's a borrowed money. Now, this is not a real money, a borrowed money that you can withdraw and then go and spend. Some people will just jump into my game. They will ask me, the money that they are going to borrow me, can I withdraw it? The money they are borrowing me, can I withdraw the money? So it is a money that is not withdrawable but can be able to give you profit when you are able to read the contracts. The borrowed money is not withdrawable, but it can help you to make good profit, right? Very good. So now, basic things like 10x, 20x, 5x, 2x, x anyway. Now, these are what we term them what? Leverage. So, when you have a capital of $10, we all have $10, $10, $10, $10, and we choose to trade with different leverages. How would the leverage impact the trading? Hmm? How would the leverage impact the what? The trading. Which simply means this particular person is using $100, that is 10 times 10. This particular person is using $200, that is 20 times 10. This particular person is using, very good. This particular person is using $5, that is 5 times what? 5 times 10, giving you 50. This particular person is using 2x, that is 2 times what? 2 times 10, that is going to give you 20. This particular person is using 15, which simply means 15 times 10, which is going to give you 150. So though your actual money is $10, but because you are using a leverage of 10, you are using a leverage of 10, you are going to amplify your capital to trade in the market, right? You are going to amplify your capital to trade in the market to make good profits. So it is assumed that this time round you are not using $10 again, but you are using $10. You are not using $10 again, but you are using $200. You are not using $10 again, but you are using $50. You are not using $10 again, but you are using $20. You are not using $10 again, but you are using $150. That is what the leverage means. That is what the leverage means. So in this case, this $10 becomes what we call margin amount. Your margin. Hmm? This $10 becomes what we call margin. The margin amount. And then this $100 becomes the position amount. So let me clean the board. Hmm? So the $20 becomes what we called this $100 becomes what's called position amount. Position amount. So you have the $100 as your position amount, and then the $10 as your margin amount. So the margin amount is the actual money. Your actual money is your margin amount, and then the position amount is your leverage money. Hmm? The position amount is your a multiple of your leverage, and then the margin amount is your actual money. If you understand this, give me one in the chat. If you understand this, give me one in the chat. If you understand this, give me one in the chat. If you understand this, give me one in the chat. If you understand this, give me one in the chat. Very good. All right. And then, all right. So we can proceed. We can proceed. So please, can you repeat? Repeat. Yeah. Okay. Okay. So someone say repeats. All right. Now we said trading on the futures market is a market based on what contracts, and the contract is signed by what you call leverage. Okay. Leverage. When we talk of leverage, it simply means you are basing on a system to get power. Okay, so the system is giving you power to trade. So you may see numbers like 10x, 20x, 5x, 15x, 2x over here. Now you have $10. I also have $10. Someone have $10, $10, $10. So this $10 is what we call it our margin. Margin. This is called leverage. Okay. This is called what? Leverage. This is called margin. So we are all using $10, but we have different leverages. We are all using $10, but we have different leverages. So when you multiply 10 by 10, we are going to get 100. This 100 becomes our position amount. That is the actual money. The money we have borrowed is $100. That is 10x of our capital. When you say 10x, that is 10 times of our capital, which is $100. So you have borrowed money. Okay, you have borrowed the money. Hmm? Good. Now, the next thing is that the next person is having $20. So 20x of his capital, that is 20 times of his capital, which is 20 times 10, giving him 200. Hmm? The next person is having 5x, which is 5 times his capital, giving him 50. The next person is having $15, that is 50x of his capital, giving him 150. The next person is having $2, 2x, which is 2 times of his capital, giving him 20. So over here, we call all these amounts position amounts. We call these $10 your actual money, which is called margin amount. And then also we have the leverage, the leverage, the leverage, right? So the profit individual trader is going to make depends on the leverage that he decide to go in or act from the market. So one trader is having 10x, one is having 20x, one is having 5x, one is having 15x, and another person is having 2x. So every single leverage that you select, and then the actual position amount you are going to get. So though we may all use the same capital to trade, but our leverage may be different. And since we have different leverage, it simply means our money exposure to is different. Now, it's clear. Hope it's clear now. Which simply means that for someone to be able to make profit in the market, the person should consider the leverage too. Hmm? For someone to be able to make profit in the market, the person should consider the leverage. So, profit making is factored on three conditions in the futures market. Profit making is factored on three conditions in the futures market. The first one is your leverage. The second one is your margin. Your leverage, your margin, and then also the price movement. Price movement. Hmm? Leverage, margin, and then also price movement. Leverage, margin, and then price movement. So I've explained the leverage to you as your borrowed money that is going to give you the hedge power to trade. And then your margin is your actual money that you are going to use to do what? To go into the market. The price movement. What is price movement? What is price movement? Now, I've been saying this that price movement is everything you need to know in trading. Hmm? Price movement is everything you need to know in trading. When you say price movement, that is the minimum or the max minimum, okay, amount of money an asset moves to add up in value. So let's assume BTC is, let's say, 120K. Okay. Now, a little movement in addition to 120K will increase the value, or a little movement from 120 will decrease the value. So every single asset we trade has got price movement. Every single asset we trade has got price movement, right? So when you go into your exchange, every single asset you trade there has got price movement. That is the reason why in Royal Kill, anytime we trade in Royal, they will tell you that okay, this is the minimum amount you can trade. This is the minimum amount you can do what? You can trade. So let's go into our exchange. You see the price movement. So when it comes to Binance, on Binance, now click on futures. Click on what? On futures. So click on futures. Over here on futures, when you come here, this is what you're going to see. Hmm? So you can see this. You can see this. That is funding and then countdown. Let's click on it. Click on the funding and countdown. When you click on the funding and countdown, click on fund rate. Over here, when you come to fund rate, click on trading rate. We have info. Okay, we have info, and then also we have trading rules. We have trading rules. So click on trading rules. When you click on trading rules, you are going to see price, minimum price movement, minimum price movement, minimum price, which simply means with this particular asset called Mina, hmm, with this particular asset called Mina, the minimum price movement is 0.0001000. That is the minimum price movement, which simply means the assets, a single price movement of 0.000 will add up to the value. So for a trader to make profit in the futures market, every single price movement either make you a profit or brings you another trouble. A single price movement here either makes you a profit based on your leverage, or it brings you in trouble, right? Do you understand? Do you understand this? Do you understand this? Do you understand this? Do you understand? Only two people are responding. Do you understand this? You are here, so respond for me to know you are following. Eh? No, you want to repeat myself. Hmm? Okay, so repeat again. Repeat again. Okay, all right. Now, you said your profit making in the futures market depends on these three things: your leverage, your margin, and then also the price movement. Price movement, which simply means before one can make profits, it depends on how the price moves. So if you go for a 10x leverage and we are all using $10 to trade, what would constitute to your profit making that's different from my profit making will be based on the price movements. Okay, will based on the price movement. So what we are saying about the price movements is that every single asset we trade has got the minimum price movement. Hmm? Minimum price movement. The little or the tiny value that the asset is supposed to move in value for us to say that this is the profit that you've made. So in your exchange, let's go back. When you come to home, click on futures. So we have home, we have market, we have trade, we also have futures, and then we have assets. Hmm? So over here, just click on what? On futures. Click on futures. So when you click on futures, on top here, you are going to see countdown. Hmm? You're going to see countdown here. Just click on the countdown. So click on it. Once you click on it, you are going to see this here, fund rate and then history. So click on it. After clicking on it, you're going to see a lot of things. Every detail about trading, you are going to see it here. You're going to see every detail about what about. So you come to see info. Info. So it's on info. Below info, we have trade rules or trading rules. Click on trading rules. When you click on trading rules, so let's click on trading rules. Let's click on it. On trading rules, you are going to see all the rules about the trade, including counts down, that is fund rate, the minimum trade amount, minimum notational value, maximum market order, and so on and so forth. What we are saying is that we are not talking about those things. We're talking about the price movement. So come here, check the price movement of this particular asset, and the price movement of Mina is 0.0001000, which simply means now a little price or a little movement of 0.0001000 is what is going to cost you to make profit or lose money. So when the assets rise, it rises based on the price movement. Every single asset rise based on the price movement. That is the reason why you may trade Solana, you may trade SRP and other cryptocurrency assets, but maybe the profits may be different or how you make the profits will be different. So let's check on Solana and see the price movement of Solana. So let's check it out. Let's click on it. So click on trading rules. Now, a single price movement of Solana is 0.10. So where is it? This is 0.0100. This is the price movement, okay? Which simply means 0.0100 could either make you a profit or bring you a loss. Now, this simply means look, someone using 20x, okay, could easily make $200 on this little price movement on this 0.000 on this 0.0100 because of the leverage. And someone with 20x could easily lose $200 because of this same 0.00100. That is what we are saying. That is what we call the price movement. So the profits we are making based on the leverage depends on the price movement. I don't know if you understand now. The profits you are making is based on the price movement. So this price would increase, Solana would increase with just a drop of 0.0100, and you are going to make good profits. And at the same time, a change in 0.001 would also create a confusion in your trade. That is because of the price movement. You understand this? Give me one in the chat. If you understood this, give me one in the chat. If you've understood this, give me one in the chat. So I've always been saying that you should know about price movement, because price movement is everything. Do you get it? Price movement is everything. That is the reason why you should be careful with the leverage you select. That is the reason why you should be careful with the leverage you do what you select. Right? That is the reason why you should be careful with the leverage you select. Very good. So you've understood now. Because if you don't take care, you go for a particular leverage, and sometimes you wouldn't know. You said the asset didn't even increase. There is a time someone gets to me and said, "Brother Emma, I don't understand. Look at the price of the asset. The price has not increased, but I'm running losses." I said, "Yes. You are running losses because of the price movement and your leverage. Because you chose a higher leverage. And the higher the leverage, the little price movement will make you or unmake you. The higher the leverage, a little price movement would either make you or unmake you." Now you understand, right? Very good. So that is futures trading. That is futures trading. So your leverage, your margin, and then also your leverage, your margin, and then also your price matters a lot. Your leverage, your margin, and then also the price movement matters a lot. Now, the next thing is that you should also know what you call liquidation. Liquidation, because I just mentioned it here. Liquidation. Hmm? Liquidation. Now, when a price moves against a trader, when a price moves against you to a certain point, okay, or a certain point, and in a futures market, it's either you are going on long or you are going on short. It's either you are going on long or you are going on short. So when we say a trade has gone against you, it simply means it has gone against your direction. So the direction could be either long like this or short like this. Hmm? The direction could either be long or short. So the trader may either go on long or may go on short. So when we say a trade is going against you, it simply means either you went on long and the trade is going on short, right? Now, in this case, when you choose a higher leverage, when you choose a higher leverage and the price is going against you, it goes against you to a certain point where your margin amount has been exhausted in the market. And once the margin amount is exhausted, you trigger to what we called liquidation. You trigger to what we called liquidation. You trigger to what we called liquidation. So for liquidation to happen, listen, for liquidation to happen to your trade, it simply means your margin amount exhausted in the market. Exhausted. Now, mind you, we said the futures market is a contract, right? The futures market is a contract. So the exchange would never wait for you to make all their money.
once you don't have any money. They gave you money because of your money, right? So if you choose a higher leverage, a little price movement will exhaust all your margin. If you choose a higher leverage, a little price movement will exhaust all your margin. And a little price movement would also make you a good profit. So you should always think about your leverage. So you should always think about your leverage before you trade. Don't just go into the market. Hmm? Don't just go into the market without thinking about your leverage. Because a little price movement against you based on the leverage will cause you liquidation. So, like I draw the chart here, someone we are all trading with $10 each. Someone with this 20x, 10x, 5x. Now, these three people, it's the probability that this particular person using 20x, when the price moves less than 0.01, he could make $20 and come out of the market as fast. While this person would need 0.0, maybe 0.2. While this person, the last person would need 0.04 before he can make profit, right? In the same manner, this simply means that when the market goes against 0.01, you are going to lose this particular trade because of your leverage, which is 20x. Whilst this person using 0.02 would still be in the market. And then this particular person will also still be in the market. So when this person is also getting out of the market with a leverage of 10x, which is 0.02, this trade will be liquidated when the market goes against him, while the 5x will still be in the market. So have you understood the concept of the leverage now? So liquidation is real based on the leverage you select. Hmm? Liquidation is real based on the leverage you do what you select. Liquidation is real based on the leverage you do what you select. Now, if you understood the liquidation, type liquidation in the chat. If you've understood what we mean by liquidation, type liquidation in the chat. Type liquidation in the chat for me to know if you've understood. Type liquidation in the chat. So before someone will be liquidated, it simply means the margin amount, which is the $10, has been exhausted in the market. So type liquidation in the chat for me to know if you've understood what we mean by liquidation. What we mean by liquidation. Very good. Very good. Yay, yay, yay. All right. So, very good. Now, let's proceed. Not yet captured. Someone say not yet captured. Not yet captured. Mhm. Not yet captured. Now, you have to capture it because if you don't capture it, the day brother liquidation will come and meet you, you will feel sorry. The day sister liquidation will come and meet you, you will feel sorry. So you have to capture it. Hmm? So what we are saying is that liquidation, hmm? Liquidation is real in futures trading because of the contracts. Because of the contracts. Now, for liquidation to happen, it simply means your actual money that you are using to trade because of the leverage you selected has been exhausted. I just simplify it here to you. Look at it. Someone is using $10, is using 10x, another person is using 20x, another person is using 5x, another is using 15. But we are all using $10. 10. $10, $10 to trade. Now, we said the price movement, the price movement is important. So because of this 10x leverage, when the price moves less to 0.01, this particular person will make profit. But for this person using 20x, So the price just moves 0.001. This particular person also makes profit because of the leverage. This particular person using 5x, the price would have to move 0. Let's say 0.5 before he will make profit. Then the person using 15x, the price will just have to move 0.01. Okay, then he also makes profit. Which simply means when the price also drops 0.1, this person will lose. When the price moves 0.01 against this particular trade, this person too will lose. And the price also moves against this 0. So with the 5x, unless 0.05, which simply means liquidation here depends on your leverage and the price movements. So the higher the leverage, the lesser the price what movement. Do you get it? The higher the leverage, the lesser the price movement. So over here, liquidation could trigger, or liquidation can only be triggered because of your leverage and then also the price movement, right? So what we are saying is that once the price moves against your trade, this particular margin, your actual money will be exhausted. And once the actual money is exhausted, liquidation will be backfired. Liquidation will backfire you and you go home. The market will bangwa you. You will not bangwa the market, but the market will bangwa you. That is what we mean. Now, before liquidation will happen, before liquidation will happen, before liquidation will happen, listen, before uncle, sister, father, reverend, doctor, liquidation will happen. There are few things you need to know. We have what we called margin ratio. Margin ratio. We have what we called maintenance margin. Maintenance margin. And we have what we called liquidation price. Liquidation price. These three things they work hand in hand and you need to learn to understand them. They work hand in hand and you need to learn to understand them. So when we talk of margin ratio is expressed just like the term is of ratio. It's expressed in percentages. Margin ratio is expressed in percentages from 0% to 100%, or from 1% to 100%. Okay, from 1% to 100%, which simply means when your trade is within this frame of percentage, you can observe the trade to see how it's going. Okay, all right. So margin ratio. Let me first talk about margin ratio. Let me use this now. Margin ratio is expressed in percentage from 1%. Is it okay now? From 1%, the person saying I should increase the test size from 1% to 100%. Hmm? From 1% to 100%, right? Now, as you keep seeing the trade from 1%, 40%, or let me use 30%, you will see green. Mostly you will see green, which simply means your trade is ongoing very well. From 30% to 80%, you will see red, which simply means your trade is too safe. From 80% to 100%, you will receive a message that do something about your trade before you will be triggered for liquidation. From once your trade gets to your margin ratio gets to 80%, you will receive a message that do something about your trade because it is getting into liquidation. So once you see 80%, it simply means your trade is getting closer to liquidation. So 80%, the exchange will send you message in your email. The exchange will send message into your email for you to respond If there is a need for you to close the trade, you close the trade. If there is a need for you to add margin, you add margin. Do you get it? Do you get it? Now, liquidation happens because your margin amount is exhausted. This means if you can add up something to your margin amount, that trade will continue to exist in the market. That trade will continue to exist in. So that is where what we call maintenance margin comes in. So the maintenance margin is an amount of money that is reserved. So you see, anytime you trade and liquidation happen, they will tell you your maintenance balance is low. That is the reason why you get liquidated. Your maintenance margin balance is low. That is the reason why you get liquidated, which simply means you should always have a reserve, and that reserve will help you to maintain your trade in the market. That reserve would help you to maintain your trade in the market. Sometimes you get liquidated and just needed something small as reserve. Likewise, your trade would have not been liquidated. Hmm? Very good. So this helps the trader to sustain his trade in the maintenance margin. So if whenever you are trading, you should ensure that just pushing all your money in the market, but at least you are maintaining. That is what we call the maintenance margin. Hmm? Maintenance margin. Now, that is it. The next thing to that you need to understand in your futures trading is what you call fund rates or fund fee. Fund fee. Fund rate or fund fee. Now, fund rates is a common thing in futures trading. Fund rate is a common thing in futures trading. This is not an interest you pay. This is not a tax you pay. This is not something you pay. This is a P2P agreement between two traders in the market, between yourself and myself. Someone say your presentation is breaking. Am I loud and clear on the line? Am I loud and clear on the line? Can you hear me? If you can hear me, give me one in the chat. If you can hear me loud and clear, give me one in the chat. Someone is saying your presentation is breaking. If you can hear me, give me one in the chat. Can you hear me loud and clear? Give me one in the chat. Okay, okay, my brother, my network is not breaking. My network is not breaking. So check your network. Hmm? Check your network before you confuse me. Check your network. Okay. Me, I'm leaving the city of Accra, and I don't have network issue. So please check your network. Hmm? Yes, check your network before you confuse me here. I'm leaving the city of Accra, Ghana. So check. Yes. All right. Let's proceed. Okay. So who are they saying your network is breaking? What network issue? Check your network. Hmm? Yes. Yes. So we are also coming to Accra. That's fine. So if you have network issue, just check your network and then stop confusing me here. I'm living in the city of Accra, Ghana. I have network issue like that. Huh? All right, let's proceed. That's just by the way. Now, funding fee or fund rate. Now, fund rate is a P2P transaction between the long traders and then also the short traders. Fund rate is a P2P transaction between long traders and then also short traders. Now, listen. Listen to this because I'm going to take time to explain the funding fee to you. I'm going to take time to explain the funding fee to you. Now, it's either you are paying funding fee or I am paying funding fee. Okay. Now, how does funding fee works? Okay. Funding fee is paid for losers to balance the spot trade or the spot market. Okay. Now, there should always be a fair balance in the trade between those shorting the trade and those longing the trade. There should always be a balance. How can the balance now when those on long are making more profit, okay, it simply means those on short are losing, which simply means the sports transaction does not balance. One market is moving while the other market is slow. So always during the contracts, there should be a balance between the price of the assets. And for them to maintain a balance, there should be a fee that those who are winning will pay to those who are losing. Hmm? So over here, when you go into your exchange, let's go back into the exchange. Let's get back into the exchange. Now, you come here. Let's go back. You come here. Over here, you are going to see this. You are going to this is a funding fee. Hmm? We have the funding fee and the countdown and every single. This is the funding and then also the countdown. The funding and then the countdown. Now looking at this, which simply means the long traders will be paying the short traders. So when you see minus, it simply means the shorts paying the long. And then when you see the plus, it simply means this is plus. It's positive. So it simply means the fund rates on this particular Solana is going to be 0.0100% on your margin. Listen to how the funding fee works. Now, it is important for you to listen because it's going to help you. So sometimes I see people saying, and I was paid funding fee, and I was meant to pay funding fee. No, it is not like that. It is not because you've kept long in the market, that is the reason you are paying funding fee. Listen, because you've kept long in the market, that is the reason you are paying funding fee. Listen to me. It is because the sports must balance. So you see, when we say the sport must balance, this funding fee thing goes beyond what you thought. On screen. Who is doing that? My brother. Look, look at this. Okay. When you look at this, there are buyers and sellers, and they balance the markets. Okay. This is what we call balance in the spot market or in the spot trade. So they balance this particular market. So for us to be balanced, for us to have a maintenance or a balance in the market, those winning the trade, it simply means those winning the trade presently are the long traders. So the long traders will pay those losing the trade. So it is not because you are losing, that's the reason why you are paying funding fee. It is not so. So when you see positive funding fee simply means the long traders are paying the short traders. When you see negative funding fee, it simply means the short traders are paying the long traders. You understand that? If you understand that, give me one in the chat. If you understand that, give me one in the chat. If you understand that, give me one in the chat. If you understand that, give me one in the chat. If you understand that, give me one in the chat. If you understand that, give me one in the chat. So not yet. Repeat, please repeat. If you understand that, give me one in the chat. Okay, okay, okay. Now, listen, listen. What we are saying is this: unnecessary payments in the futures market, not for the exchange, not for not for me, but for us. Which simply means all those. Listen. So when you come into your exchange, there is what you call funding, and then also counts down. So for now, I'm talking about the funding. Now I'll talk about the countdown. Found down. What it does mean is that you see who is writing in my screen. Hmm? Stop doing this. You see, this thing, it's nursery, KG people that little children that have been doing that. Hmm? So stop doing that, okay? Don't write. You are here to learn, and you are still here to. You are here to. You are here distracting the class. Stop that. Hmm? That's what you are doing. Hmm? Isn't nice? You yourself, what you are doing, isn't it? All right. So this is the countdown. Now, with this, it simply means it is plus. That is, you can see that it's positive. We have negative funding fee and then there's a positive funding fee. When you see positive funding fee, it simply means the long traders are going to be the one to pay to the short traders. And then when you see negative funding fee, it means the short traders are going to pay to the long traders. That is what it is. Now, how are they going to pay? I- This in this particular trade, once you see the positive funding fee, simply means the long traders are the one winning the trade. And in order for them to balance the spots, they need to pay those on short so that it can balance. And if those on shorts are also winning, they also need to pay those on long so that there can be balance transaction. So that they can be balanced in the transaction. Maybe for me to talk about the balance in transaction, that one I have to go on advance. So let me not go more further on that. Now, it follows a countdown or a time within which it should be paid. So single asset you trade on has got its own funding fee and a countdown time that is supposed to be paid. So when you click on this particular asset funding rate, click on it. Over here, sorry, when you click here, we have funding rate history. Funding rate history. So over here we have the interval, and then the funding cap floor, as well as rates, previous rates, and then also next funding rate, right? So interval simply means it is paid on Solana, it is paid every 8 hours. On Solana, it is paid every 8 hours. On Solana, it is paid every 8 hours. When it comes to the percentage changes. The percentage changes. Now, the fee changes. The fee is not fixed. The fee is not fixed. The fee is based on who are winning, the momentum of those winning the trade. Listen, the fee is based on the momentum of those winning. Do you get it? So on Solana, it is 8 hours. When you look at the 8 hours over here below, you can see that now the 8 hours is counting. Now the 8 hours is what? Is counting. The 8 hours is counting, and It's remain with 7 hours 38 minutes 6 seconds. 7 hours 38 minutes 56 seconds. So the countdown keeps moving, and that is how the funding fee works. When your trade continues to be in this market on a short trade within this particular time, you receive funding fee. And when you are on long on this asset within this particular time, you will pay funding fee. If you understand this, give me one in the chat. If you understand this, give me one in the chat. If you understand this, give me one. If you understand this, give me one in the chat. If you understand this, give me one in the chat. If you understand in the chat. If you understand this, give me one in the chat. So you see, sometimes I see some people would be like, oh, and this fee, it's not good at all. The funding fee is a cheat. I'll just look at the nose of the person and be like, huh? What are you saying? The funding fee too is a cheat. So you what at all do you want? You want to make free money. You want to do anything. Hmm? Hmm? And always I've been paying funding fee. I've been paying funding fee. Someone came to that's one of my dad again. My leader, hey, the way the funding fee I've been paying is too much. Oh, I've been paying funding fee too much. So you also earn funding fee. So these are the funding fee work. Hmm? These are the funding fee works. So now, one thing about the funding fee too is that it's calculated based on your position amount. The funding fee is calculated based on your position what amount. The funding fee is calculated based on your amount. So let's assume you have $10. Okay, let's assume you have $10. Your actual margin is $10. Your leverage is 20x. Okay, your leverage is 20x. Now on this 20x, it means your capital is going to be $200. $200. I'm giving you this insight. Listen, $200. Over here in the exchange, you realize that they said this particular funding fee is 0.01%. 0.01%. Look at it. So 0.01%. This is it. This is the funding fee, funding rate you are going to pay. 0.0100%. Which simply means that, which simply means that, which simply means that they are going to calculate 0.010% on $200. Okay, so let's do that calculation to see. Let's do that calculation to see. So $200 times 0.0100%, which simply means on each $200, on each $200, on this $200 that you have, based on this particular fund fee, if you are on long trade, you are going to earn 0. You are going to pay 0.02%. Sorry, 0.02 out of your margin. So if your margin is $10, you are going to pay 0.02 out of it. You are going to remain with, let's say, 9.9908 something. Let's assume so. So let's do that deduction and see. Let's do that deduction. My money is $10 minus 0.02. Going to remain with, we are going to be remain with what? With 9.98. That is what you're going to be remain with. So this is going to be your margin. So they've deducted this out of your margin because of the leverage, right? And in other words, if they also pay you, it is going to add up, right? So this is one of the reason why people get liquidated, because they pay this amount, it reduces their trade. So you see, your actual money is $10. and now you paid something out of it as funding fee, so you are remaining with 9.9. Another time you pay again, it's going to reduce, which simply means your margin amount keeps decreasing. It simply means your margin amount keeps decreasing. That is the reason why you will be liquidated. Okay. So when is this fund fee paid? Okay. When is this fund fee paid? Fund fee, you can't see it on Royal Kill. The fund fee is a term in the general trade or the general market, which is the exchange, not Royal Kill. So when is the fund fee paid? The fund fee is paid if your trade is in the market after this countdown is over. You will pay this countdown. That is a 7 minutes, 7 hours, 32 minutes, 45 seconds. After this countdown, you'll be part of those to pay because it is the long trader that are going to pay. And one thing is that you may not be in this market, but you join this market late or you join this asset late, and the countdown has remained with, let's say, 1 minute or 30 seconds for it to be paid. 30 seconds for it to be paid. And you open a position. Okay, you've opened a trade. Once this trade is open, you are still going to pay the funding fee because it remains with 30 seconds. And you are going to be part of those to pay. So far as you open the trade within this time rate of the funding fee to be paid, you'll be part of those to pay. You understand that? If you understand that, give me one in the chat. If you understand that, give me one in the chat. So someone is saying I can't see funding fee in my exchange. Which exchange are you using? He said, will you pay the full amount? I just did that here. So listen, you are paying this. The funding is this amount. Sorry. So they said the rate is 0.01%. This is it. The funding rate. That is, it is expressed in percentage. So 0.0100%. That is what you are going to pay. So if you have position amount of $1,000, you are going to pay 0.01% of 1,000. That is going to be your funding fee. So it is based on this percentage. Okay, based on this percentage, which simply means the trade is closed before time. Before time, you are free to go. Once your trade is closed before time, you are free to go. Once your trade is closed before time, you are free to go. You are not going to pay any funding fee. You are not going to pay any funding fee. Now, in the same manner, you can also check out to see. Listen, you can also check out to see. There is a way you can also be earning, not just be paying. So let's assume now we know that this particular trade be the one to pay the funding fee. Tell me in the chat box who will be the ones to pay the funding fee in this particular trade. Who will be the ones to pay the funding fee in this particular trade? Who will be the ones to pay the funding fee in this particular trade? Tell me in the chat. Tell me in the chat. Who will be the ones to pay the funding fee? Who will be the one to pay the funding fee in this particular trade that you can see here? Who will be the ones to pay the funding fee? Tell me in the chat. Who will be the one to pay the funding fee with this particular Solana trade? Who will be the one to pay the funding fee? Who will be the one to pay the funding fee? Who will be the one to pay the funding fee? Very good. Very good. Very good. Very good. So the long traders are the ones that are going to pay the funding fee, right? Which simply means if I enter short, yeah, if there is an opportunity and I enter short here, I'm going to earn funding fee. You get it? Do you get it? If there is an opportunity for me to enter shorts with this particular trade and I enter, I will also earn funding fee. So let's assume I have $1,000 on short position. $1,000 on short position. Hmm? I have 1,000 USDT on short position, and the funding fee is 0.3. The funding fee is 0.3, and the long traders are the ones to pay. Let's go and do the calculation to see how much I will earn in addition to my margin. No. So thousand thousand times 0.3%. Ah ha ha la la la. So I'm going to earn. Is this I entered I said 3%. No, 0.3. Sorry, 0.3. So I'm going to earn $3. I'm going to earn $3. Hmm? I'm going to earn what? $3. I'm going to earn $3 in addition to my $1,000. In addition to my $1,000 as a short trader, since they are on long and I go on short, I'm also going to be part of those earning the funding fee, and I'm going to earn $3 in addition to my margin amount. If you understand that, give me one in the chat. If you understand that, give me one in the chat. If you understand that, give me one in the chat. So when is please, my question is, the countdowns are already it has already started. So it's 8 hours. So look at this. Let's change the assets. If you understand, give me one in the chat first. If you understand, give me one in the chat. So the countdown has already started. Listen, this is it. Let's change the assets. Let's use different assets. Let me use this asset called running. Running. Now look at this asset with a high funding fee of 0.00. Okay, that is 0.008. 0.008. Now, let's look at when it started. They said 8 hours. Let's see the time duration for this particular funding fee. So when you click on this is 4 hours. The interval is 4 hours. It simply means every 4 hours they will pay funding fee on this particular asset. Every 4 hours they pay funding fee. Now, look at this. The funding cap floor, that is the highest funding fee, is 2%. Is 2%. The highest funding fee on this particular asset is what? Is 2%. Hmm? Good. Now, what you are going to pay presently is 0 point what? 5, 0.005%. And then the countdown is 3 hours, 25 minutes, 25 seconds. 3 hours, 25 minutes, 22 seconds. That is the countdown. So after this countdown, that is what they are going to pay. Oh, that is what they are going to pay. Okay. So this is what it means. So after the 3 hours, 25 minutes, and 1 seconds, they will pay this particular funding fee of 0.05%. Of 0.05%. If you understand that, give me one in the chat. If you understand that, give me one in the chat. And I believe your question has been answered. I believe your question is answered. All right. If you have any question, so is there need to go on long if you can earn funding fee or short? No, that one will based on your trend, the trend of the market. If you want to go on short, it will depend on your analysis or the signal given, right? So you can't just go on long because short because you want to earn funding fee. If the market goes against you, your funding fee will be in waste. Hmm? So in trading, we size opportunity where there is an opportunity. We size opportunity where there is what? An opportunity. That is one thing that you need to know. So is this fund fee paid once every after?
giving countdown? Yes. So after every giving countdown, it is paid. After every giving countdown, it is paid. After every giving countdown, it is what? It is paid. And you need to take notice of that. So if you trade on these hours, let's say there are some assets that have 2 hours interval, which simply means every 2 hours they pay. Every 2 hours. There are assets that have 1 hour interval. 1 hour interval. The highest interval is 8 hours. So you should take notice of that. Now, if you have any question, you can feel free to ask. If you have any question, you can feel free to ask. So where do you see who is going to pay funding fee? Hey, my brother, where do you see who is going to pay funding fee? I just showed you here. So come here in your exchange, you can see countdown. This is it. This is what you are going to see. Hmm? This is it. So when it is positive, that is 0.0050. Simply means it is positive. When it is negative, so let's see if we can get a negative countdown. Let's see if we can get a negative countdown. Let me use this. They are all positive because the long traders are the market is very bullish. So um let me see. So let me use this. Okay. This is also positive. Okay. So over here, this is what you are going to see, right? Okay. Let me see. Hmm, Funding funding history. So at your free time, you can cross-check the funding history at your free time. So you can see negative funding history. You can see negative. This is it. This is an example of negative. This is an example of negative funding rates. Okay. Which simply means the short traders paid it. The short traders paid. The short traders paid. Do you get it? Yes, that is it. So if you want to know when you can pay, just check the countdown. When you check the countdown here, when you check the countdown here, when you check the countdown here, you will know when you pay the funding fee. All right. Now let me see the next question. So meaning if a coin takes 2 weeks on the 2 weeks on market, one can easily lose all his or her capital on that funding fee. Say if one had only $20. No, that is not the case. That is not the case. How much is the funding fee? It's not even up to $1. Hmm? It's not even up to $1. It's not even up to $1. So unrealized P and L -7, 158, 154.22. What it means? So when we say P and L, when we say P and L, profits and loss, profits and loss. Okay. So when you see positive P and L, it simply means so there are some messages you see unrealized. So when you see positive P and L, when it is positive, it simply means you are in profit of that amount, which is profit of 7.6. When you see negative, it simply means you are in a loss of. When you see negative, it simply means you are in a loss of -7.6. That is what it means. When you see negative P and L, it simply means you are in a loss of -7.6. All right, so hope I've been able to explain that to you. Now, when setting the coin, are we supposed to put the coin on isolated or hedge mode? Are you supposed to put the coin on isolated or hedge mode? Are you supposed to put the coin on isolated or hedge mode? There is nothing like putting a coin on hedge mode. There is nothing like putting a coin on hedge mode. Now, listen, we have cross margin and then also isolated margin. You either decide to put your coin on cross or isolated. It's all good for you. You either decide to put your trade on cross or isolated. It's all good for you. When you put your trade on isolated, it helps you to reduce total loss when liquidation happens. And when it is on cross, you are capable of losing all your money in your futures account when liquidation happens. So when you put a trade on cross, cross is good for margin calls. If you open margin calls, cross is good, especially with one trade, it will be able to buy more. And cross also utilizes your margin calls. But isolated does not impact margin calls. Okay. Though margin calls work, but it's not effective as cross margin. Hmm? It is not effective as what? As cross margin. But then when you are using cross margin, your trade runs smoothly until one thing begins to happen. Isolated. Sorry, until liquidation happens. When liquidation happens to your trade, I didn't want to go back, but then let's work on that. So before this cross thing will happen, this is cross, okay? With cross margin, Hannah, stop writing in my screen. Now, for cross margin, when you are trading on cross margin, your capital is shared among all the trade. If you have four different trade in the market, if you have $100, this $100 is shared among the four trade to trade. If one trade loses fund, it will go for fund in another trade to continue the trade. Hmm? So when all the trade or when one trade loses its energy to the extent that it cannot trade, it will liquidate all the remaining trade in the market, which simply means on cross you are safe until liquidation happens. So once liquidation happens, you are going to lose all your money in the futures account. And then we have isolated. With isolated, margin calls are not effective, though it can buy margin calls, but they are not effective as cross margin, right? And when liquidation happens on isolated, it's only if you have four trade, it only liquidates one. That particular trade that has loses fund, that is what will be liquidated, and then the remaining will be in the market. The remaining will continue to be in the market. So if you use isolated, you are just reducing the risk of getting total liquidation from all capital, right? If you use isolated, you are just reducing the risk of getting liquidated from total capital. All right. So, and then the hedge that you asked, when we talk of the hedge is a different thing altogether. Hedge is the ability of a trader. Hedge, the ability of a trader to trade on a single asset. You are trading on single assets using two different positions. So when you say someone is hedging the trade, it simply means you are longing and shorting at the same time. So you can long and short your trade at the same time. So if it is Solana, you can long Solana and short Solana at the same time. All right. Okay, so understood. Understood. That is good. So what is change leverage ratio failed? Change leverage ratio failed. Now, anytime you see this change leverage ratio failed thing, it simply means you have to go back and check your future settings. You have to go back and check your future settings, not in your exchange, but your API. Your API. Hmm? Your API. You need to work on your API for the futures accounts again. You need to work on your API for the futures accounts again. So anytime you see that, restart your API binding, unbind and then or replace it and then also do it again. So let me see. Um which are the best coin to trade with? The ones having short intervals or long term interval? No, there is nothing like that. you need to decide based on your um based on the trend of the market. So my API is failing since yesterday. What should I do? What should I do? Not allowing the English is Englishing. So what should I do? Not allowing me trade futures, yet my futures is enabled on. If your API still fails, I don't know if you are in Africa or else Europe or wherever you find yourself, this disconnect the API and then also or unbind and rebind again. It's simple as that. Unbind and rebind. That is all. So if you hedge, wouldn't liquidation catch you up? No. Hedging trade does not mean that liquidation is going to catch you up. Hedging trade does not mean that liquidation is going to catch you up. Does this mean they will liquidate all my 1,000 USD if it reached liquidation? Yes, for liquidation to be triggered, liquidation is not common, yet it is common. Before liquidation will get to your home or your house, it simply means, my brother, you are out of the game. Before doctor, reverend, uncle, father, liquidation will get to your door, it simply means you have gotten to the messy part of the game. It simply means you have gotten to the messy part of the game and you'll go home. Okay, so what if the countdown ends when it is neutral? What if the countdown ends when it is neutral? Yes. So there is what we called um equilibrium states. Okay. So a trade may be in an equilibrium, which simply means buyers and sellers are not winning. It simply means the trade, and most it's difficult to happen. That buyers and sellers are not winning, which simply means the trade is in an equilibrium state. The market is in a sideway. There is an equilibrium state in the market. When this happen, yes, when this happen, the countdown is going to be the fund rate is going to be zero. The fund rate is going to be zero. That is what you call neutral countdown. The countdown is going to be zero, which simply means that trade is in equilibrium state, which simply means at that within that particular interval, neither long traders or short traders are going to earn the fund fee. It simply means the spot is balanced. There is an equilibrium. So if you hedge, wouldn't liquidation catch you up if your trade capital is finished? Now your capital, you don't get liquidation because your capital is finished, but then because your trade has been exhausted in the market. Hmm? That is it. So, and of course, if your trade gets exhausted, you'll be liquidated. Please help me with configuration settings on Royal Kill, having 15% drop using an account with 3,000 Banga Banga strategy. So I will urge that for trade settings issue, I wouldn't like to talk about trade settings issues here because this particular class itself is broad. So adding trade settings to it is going to complicate things. So I'm sure this evening I'll be back here. I'm sure this evening I'll be back here. So maybe we'll talk about the trade settings issue. So get prepared. I'm sure this evening I'll be back here again. Notwithstanding, you can go on the YouTube to watch trade settings that is taught by leader Chris Mondays. So if hedging avoid liquidation, why people are liquidating? Is there amount of capital to qualify hedging? No. We are not saying hedging totally avoid liquidation. When we say hedging, listen, it simply means you want to size opportunity where there is an opportunity. That is what it means. So the trade is on long and the market is going on short. So you want to size opportunity on the short market before it gets back to the long. That is what we mean by hedging. The trade is on long and the current price trend is going on short. So you are just sizing the opportunity on the short market. That is all. You are sizing the opportunity on the short market. That is what we mean by hedging. So you hedge a trade to size opportunity. Okay. So what is always the percentage gap between the entry point and the liquidation price? All right, it depends. It depends. So there is no fixed value for that. It depends. So please, can you explain banga banga strategy, my brother? So I please, if God permit, this evening we will talk about that. This particular class is for introduction to explain the terms and then also how they work for you to understand the futures trading. So things regards to settings, strategies and everything. I think also we have to transform that into another lesson. We have to transform that into another lesson. So please help me with configuration settings. So like I've said, I guess very good. So that is all. So please, anything with trade settings, that is not the mission that I came here to perform. I came here to introduce the lesson, that is introduction to futures trading, to explain futures trading to you, for you to understand the terms, the relationship between the terms and how they works so that you can be able to understand. So understand that for me and know that if God permits, I'm sure this evening I'll be back here with you. This evening I'll be back here with you for us to learn together again. So get prepared. I'll be back here. Okay, so I guess Percy Niketa. If I'm right, I guess your question is what I've done justice to it in the chat box, right? So if your hand is up, I don't know if you want to say something aside that. You let me hear from you. If it's not about the three settings, then let me hear from you. So you've been asked to unmute. So Percy, you can ask your question.
Yes. Can you hear me?
Yeah, we can hear you.
Yes. My question was, if my wallet capital in futures is say 1,000, but I enter the
Mm,
trade with $100 and I cross, yeah. If the
mm-hmm.
liquidation price comes, will it take beyond the $100? Will it wipe out the entire wallet of $1,000 as opposed to the only money I put in the trade?
Yeah, so under cross, what's that? So sorry. Under cross margin, before liquidation will trigger it, liquidation will eat all the money in your account first, in the futures account, um
Mm,
before
mm,
it will trigger to liquidation. So if you have any money aside $1,000, it will go in and then use it. Now, the purpose of cross margin is that the cross margin always want to ensure that your trade is safe in the market. So if you have any money in the futures account, the cross is
mm,
very inquisitive and he would always want to use that money to sustain your trade. Do you get it?
mm. Yes.
Yes. So that is the reason why it will go for the remaining money. But you know, it go for that money and yet your trade don't have potential or your capital is still not enough to sustain the trade, which simply means it has to liquidate. And getting liquidated, it has already used all the money, which simply means all your money is going to be liquidated. Do you
Okay.
understand? Very good. But if
Okay.
it's happens to be on cross, isolated, only that $1,000 will go out, and then the remaining that you still have on the futures will still remain in the market.
Mm.
All right, that is all.
Okay. Thank you. Thank you.
You're welcome. All right, so I think there is no hand up again. And let me see in the chat box. Let me see the chat box if there is. So what can I do? What can we do when the trade is against us? I mean when liquidation starts. So I think I have to add that lesson to the evening session. I have to add that to the evening session. So prepare and let's meet this evening. Prepare and let's meet this evening. Okay, prepare and let's meet this evening. So can I get liquidated when margin calls is still available?
So in all cases, you get liquidated when all the money has been exhausted. So mind you, you can also buy margin calls, and after your money is finished, everything is exhausted and still liquidation can happen. But then the margin calls help you. So this one I'll talk about the effect of margin calls on trade. The effect of margin calls on trade. So how can I manage liquidation on isolated coin? Will I add more money to sustain the isolated? So this evening, please, I'll handle all those questions. I will treat all those questions. What is it that when buying margin calls, the liquidation will become close? Please, anything aside our introductory lesson, I will talk about that in the evening. So get time and join us in the evening so that we can learn about things relating to trade settings and then also its related questions. Trade settings and then its related questions. So which means that on course you can only be liquidated if the money in the futures wallet fail to sustain the margin. Exactly. Exactly. So at what time? Yes, the same time. Our meeting times. Our meeting time. So I think 9 o'clock East African time. 9 o'clock East African time. Either 8 o'clock or 9 o'clock East African time. So get prepared. The link will be shared on the platform before time. When I use double up and the robot buys in more money, if liquidation happens, will it take it all? So guys, I think um please you can correct me with the time that we can update those who want to join us this evening. So I think that is 6 o'clock in Ghana time. That 6 o'clock is 8 o'clock East African time. Okay, 8 o'clock East African time. That is 3 hours ahead. So East Africans are ahead of Africans, West Africans 3 hours. So 3 hours. That is 6 o'clock. So that is going to be 9 o'clock rather. So 9 o'clock East African time. So get prepared for that. All right. It will be nine. Yeah. Okay. So I think we'll end here this morning. We spent 2 hours here and it's enough. I learn in a very hard way. Yeah. It's good to learn. It's good to learn. Learning is good for your soul. So it's good to learn. It's good to learn. All right. So guys, yes, it's good to learn. So guys, we will end here. If God permits, this evening we will meet again. If God permits, this evening we will meet again. So I wish you all the best in your trading journey and trade with caution. Don't trade against the trend. Trade according to the trend of the market and make more profit. And make more profit. And make more profit. So get prepared and let's meet again this evening. I wish you all the best in your trading journey and have a good day. All right. Love you all. Bye bye bye.